In the universities of mere mortals, when you go to do your undergraduate, you typically say that you study something. But when you go to the lofty heights of an Oxford or Cambridge, you don't study, you read the subjects. And our next speaker read economics at Oxford, Cambridge. He later descended from those lofty heights to a little school called Harvard, where he eventually joined the faculty, as it is my understanding. He then went on to become a financial and economic consultant, providing advice around the world after probably during and after a successful academic career. Later became the chief economist with the Economic Development Bank of Bahrain, if I'm correct. Close enough. And he is currently the chief of planning and monitoring at Bahrain's Labor Fund, Takim, which was one of the big winners at last night's World Excellence Awards. So please welcome Dr. Jarmo T. Kotilaine. Thank you very much.
Within the statistical margin of error. Yeah. All right. Good afternoon, ladies and gentlemen. I think you all deserve accolades for staying after lunch. I have short remarks about how economic change will drive innovative entrepreneurship in the Gulf, and I've prepared some colorful slides to make my possibly long-winded arguments easier to follow. Now, where is the FDI connection, you might wonder? Hear me out, and all will be revealed in due course. I will start my presentation with the not-so-good news, and hopefully this will give me a chance to put the narrative on a more positive trajectory as we go along. Now, those of you who read the papers know that there is, in some ways, a very momentous period of economic change underway in the Gulf countries. And you can see the impact of that change when you do what I've done. In other words, you put the annual GDP, real GDP growth rates of all these countries since the year 2000 and watch what happened. So you can see there was quite a bit of volatility in those numbers up until about 2013, but the average was quite high. Many of these countries were sort of achieving Chinese-style growth rates at the best of times, and the average was generally to the north of 5% a year, which isn't bad. You can see that two things have happened since about 2013-14. A, there's much less volatility, but also those growth numbers have flatlined, and now the new trend is, broadly speaking, half of what it used to be. And you can also see that the growth has not significantly responded to changes in that thick, I don't know what color this is, dark blue line, which is the oil price, which in the past used to be the main driver of economic growth rates. Now, why is this, you may wonder? And here is my simplistic answer. As I see it, the growth narrative of the GCC countries has proceeded in three somewhat overlapping chapters. Of course, initially, starting in the 30s, it was all about the government at that time, through foreign companies, pumping oil out of the ground and then distributing these oil revenues across the economy, which then drove development and drove growth at a very impressive and transformative pace. A new story started to emerge during the oil era, but it became particularly evident in the sort of roughly after the turn of the millennium. And this is what I call the Great Arabian Infrastructure Boom. And this was all about building the big airports and seaports, and new cities rose from the desert, and new people came to the region to build them and to make use of them. And that is really what drove these impressive growth rates that we saw during the first decade of this millennium. But of course, the reality is you cannot keep building forever and expect to achieve the same IRR that you did when you first started. And I think in many ways this narrative is now sort of past the point of diminishing returns. There are concerns about duplication, there are concerns about efficiency of capacity utilization, etc. It has achieved a tremendous amount. It has made the Arabian Peninsula a key hub for global logistics, for global trade and travel, but it is a gift that is not giving quite as generously as it used to. So there is a transition underway, and one of the sort of best known ways of articulating both the need for and the nature of this transition is probably the Saudi Vision 2030 document, which is all about envisioning a kind of a post-oil future. But I think the reality is what really has to become the growth driver after these first two chapters is productivity. How efficiently you utilize capital rather than just how much of it you put in or you put up. So these two eras were all about input accumulation, as we economists like to call them. Now we need to find a way of transitioning to a more productivity-led growth model. Of course, one of the implications of these new oil price realities is that, as again you doubtless know, all the Gulf countries have embarked on a significant overhaul of their fiscal models, of the role of the government in the broader economy, so to speak. And this has very profound implications for the way businesses work in the Gulf. As I sometimes put it, no macro without micro. As the macro growth rates have slowed down, something has to be happening at the company level. And what has been happening at the company level is that a model that existed for decades, where companies could expect to see steady growth in their top line revenues because of government spending, because of the growing population, etc., and where they didn't, generally speaking, have to worry too much about their costs because of this distributive government fiscal model, which subsidized a lot of the key inputs, and of course they had easy access to relatively cheap labor. The new realities are about these margins being squeezed almost across the board, and the outlook becoming much, much less certain. So, in the most simplistic terms, what has to happen in the region at the corporate level is companies will have to find ways of living with and responding to uncertainty in a way that they didn't have to in the past. And the pace and nature of this transformation at the grassroots level is, in my opinion, one of the key determinants of how this third chapter, if you like, will play out. But what is important here is that it is creating what in economic terms could be called a structural demand for innovation, for thinking differently. At the same time, of course, as you know, the governments in the region have been investing more and more on the supply side of innovation. There have been massive, ambitious investments in new universities, research centers, etc. And we are seeing this also at the corporate level, where some of the big businesses, Aramco, Sppech, etc., are putting more and more money into innovation, into product development, in a way that didn't necessarily used to be the case. Now, why do I think that the time for change has come? Because I think really for the first time in the recent history of the region, we have, if you like, the supply of innovation and the demand for innovation, the structural demand for innovation, coming together in a way that should create a sustainable basis for change. If you like, innovation and change now is becoming the norm. So necessity is the mother of all innovation, as they say. We're beginning to see this already quite clearly at the corporate level. This is what I call my tree of low-hanging fruit. In a sense, the good news for Gulf corporates is that because they did not have to invest in change during all those decades, there are lots of quick wins. There are lots of ways of making companies stronger, more resilient, more productive companies. And these are sort of examples of those things. And more companies are beginning to pay attention to their business models. Of course, at the national level, there is another dimension of this, which is about more efficient utilization of these massive infrastructure investments that have been in place. So what is my conclusion? And here finally we get to FDI, among other things. I think we now have a confluence of the key preconditions for sustainable innovation, sustainable change at the corporate level, as well as at the macro level in the Gulf countries. And I think that this is potentially the source of many important, exciting changes. I think what this means for the Gulf countries is that FDI in various ways will have to be an important driver and supporter of that change. It also means for the FDI that it will probably have to evolve from its past norm. So there was a time where we can, with a little exaggeration, say that these sort of cut and paste investments went down well because the Gulf had the money and had the interest in economic diversification, and of course there were ready-made models available. Now, I think there is a much greater interest in smarter FDI, in advice, in support, in acquisitions of companies, in changing business models, and even in innovation. And new ways of mobilizing capital, to connect back to Mr. Hayek's speech. In other words, as the governments reposition themselves, their role in the economy, they also are looking for new ways of bringing capital into the region. And of course, engaging the private sector, including foreign investment, in terms of creating assets and operating those assets, whether it's through PPPs or it's through privatization or partnerships, is very much emerging, I think, as one of the key trends of the future. So bottom line, lots of things are changing, but I think there are significant opportunities for investors, not only within the region itself, but for investors who can then utilize the region as a springboard for the large emerging markets of Asia and Africa. I think what the Gulf countries have done extremely well is they've enhanced their advantages in infrastructure, in connectivity, and increasingly also in the area of regulation. So it is a good place to do business in, but a place to do business in also for its very large and rapidly growing near neighborhood. Thank you very much.